RBI MPC Monetary Policy Committee meeting started on the 8th of February and concluded today on the 10th of February. Now, RBI Governor Shaktikanta Das, in his address to the press, spoke about the various decisions that were taken in these 3 days. Let us discuss key takeaways from this meeting and how they are going to affect our investments. You should always try to reason when someone is telling you something. Asking the question why is utmost important. Why is she making a YouTube video about what decisions were made in the MPC? Why does she want us to listen to what the MPC decided? Well, all of us theoretically know that RBI is a banker's bank. It is the central bank that manages the banking system in the country. Like we as commoners use the bank as an intermediary, either to deposit cash, withdraw cash from the ATM. As long as my mobile is able to pay my bills, I am happy. I either go to the bank to take a loan or to keep a fixed deposit. Yeah, simple things that I do with the bank. Why should I be bothered about what RBI is doing? You should be bothered. How does it affect you? I will tell you in this short video, in a short span of not more than 5 minutes. It is loaded with value. Please keep on listening. Now, MPC normally is held 4 times a year and it decides on the monetary policy of the country. Yeah, the central government, what Nirmala Sitharaman did in the budget, she decided on the fiscal policy of the country. RBI decides on the monetary policy of the country. So when they meet 4 times a year, they decide on how much flow of money should be available in the market. Is it necessary to suck up some money, or is it necessary to keep the flow or increase the flow or keep it at the same level? How does this affect us? When the flow of money increases in the market, we get money easily and the price for that money that we get is low. Correct? When the money is sucked from the market and there is demand in the market, but the supply has curtailed, what is going to happen? The price to get that money is going to go high. Simple? Right. Now, when RBI decides on the money supply, it has 2-3 ways in which it can decide. The first and the very essential rate that all of us should be aware of is the repo rate. Now, what is the repo rate? Repo rate is the rate at which banks borrow money from RBI on a short-term basis. Now, when we borrow money, when we take a loan from the bank, we have to pay interest to the bank. Likewise, when banks borrow money from RBI, they have to pay interest on that borrowed amount. Now, this interest rate that the bank has to pay to the RBI is called repo rate. What is the repo rate? The repo rate is at 4%. This 4% has not been changed from the last 10 MPC meetings. Right from May 2020, onslaught of COVID, this repo rate has been unchanged. It is same all 10 meetings previously. What does this mean? What is the current FD rate that your bank is offering? Somewhere around say 5.5 to 6.5% depending on senior citizen and the period for which you keep your FDs. Right? Now, when we keep FDs in the bank, what does the bank do with the money that we keep with them as fixed deposits? Are they just going to keep the money with them? No, they lend it. They give it away as loans at higher interest rates. Correct? So, this is what the bank does. It is the basic business of a bank. It takes money from people as fixed deposit, pays interest to the people. So, a fixed deposit is a liability to the bank. Right? It lends that money to the needy, charges interest on it and earns interest on the money that it has lent. Correct? The gap between the interest that it pays to the fixed deposit holders and the money interest that it receives from the loan takers is the income of the bank. Correct? Simple. Now, when RBI is giving loan to the bank at 4%, do you think banks are going to make FDs attractive and take money from you at 5.5 or 6.5%, whichever is applicable? You got your answer. The answer is plain simple no. If they are going to get money at a lower interest rate from RBI, why will they make their FDs attractive? Correct. So what is the correlation between repo rate and FD rate? When the repo rate goes up, so borrowing money from RBI becomes expensive. What does the bank do? They increase the FD rate. They make the FDs attractive. They start taking your money. Correct? Borrowing money from you. When the repo rate goes down, what happens? FD rates also go down. So repo rate and FD rate are directly proportional. Repo rate up, FD rate up. Repo rate down, FD rate down. Do you understand? What will happen to the loans? Loans also will be cheaper if banks are getting money at a cheaper rate. Do you understand? Right? When the repo rate, when the banks are able to borrow only at a higher rate, the loan rates are also going to increase. Why? Because they have to earn like the gap between the lending rate and the borrowing rate is what they are going to earn. So if the borrowing rate is going to increase, the loan rate is also going to increase further, so that this gap is their earnings. Do you understand this relation? Right. So this is why what happens in an MPC is very, very necessary for commoners like us.